How you doing?
Good. Okay, I think we're ready to go. Welcome back. Housing Summit 2.0 Progress Report. Again, my name is Todd Latham. I'll be your host. This event is presented by ResCon. You can see their logo behind me, and sponsored by the Toronto Regional Real Estate Board and the Federation of Rental Housing Providers of Toronto. Hope everybody is using the app, the community board, the attendees section, the documents. And if you have any questions or concerns with using the app, please email sarah@actualmedia.ca. During this session, if you have any questions, please type them into the chat and we'll get them to our speaker for the QA portion at the end of the session. So without further ado, I'd like to introduce you to Jason Mercer for our current state of housing supply update. Jason is the Toronto Regional Real Estate Board's Chief Market Analyst and Director of Service Channels. Over to you, Jason.
Thank you very much. And maybe Todd, I'm going to share my screen and maybe just give me, tell me if you can see it or not. Should be up.
Yep, looks good.
Okay, great. Well, thank you very much, Todd, and to the rest of the folks at ResCon. I'm really happy to be taking part in this event again on behalf of the Toronto Regional Real Estate Board. I think it's important to have this update after the initial conference we had earlier, and we've seen a lot of change sort of unfold in the marketplace, over the last few months, and a lot of that, obviously has been focused on the demand side as we've seen the impact of higher borrowing costs on demand. But at the same time, looming in the background are still, the constrained supply of housing, both in the resale market and the new home market, that will impact this marketplace in the GTA and broader Greater Golden Horseshoe for the years to come. And I know a lot of you are familiar with TREB, and certainly, I know a lot of you personally, and we've talked about the market a lot over the years. But for those who are not, just to give you a sense of TREB's breadth, we represent some 70,000 members and partner board users of our MLS system. And what we found in consumer polling over the years is that when you ask people if they're intending on purchasing a home over the next year, and then ask, are you planning on using a realtor? By and large, we've seen, a pretty consistent, high 70s to low 80% mark of people who say they're going to use a realtor. And I'd argue at the end of the day, that percentage is even higher because of the cooperation that exists between realtors and builders in the GTA. And so you'll often have individuals that are going to enter a sales center and either purchase a home as an end user or an investor, and end up using the services of a realtor as well. And so at the end of the day, that share actually increases, I would argue. But looking at that share, the activity that our members take part in and year out is very representative of conditions that we see in the market. And in fact, if you think about the breadth of our members and MLS system users activity over the last decade, it's really broadened. If you think back to the recession, 2008, 2009, or just before it, only about 7% of the transactions or residential transactions reported through our MLS system were outside of the GTA proper. If you look through now year-to-date 2022, that number is getting on 30%. So almost a third of transactions that our members and system users are taking part in are actually outside of the GTA. And so we're talking about those surrounding GTH municipalities, Hamilton, Kitchener-Waterloo, Barrie, and down through Peterborough and everything in between. And I think, this first slide actually speaks to the emerging supply issue and its impact over the last decade or so, because as we've seen a greater and greater constraint on supply, whether we're talking about single family homes or condominium apartments and everything in between, that's obviously seen, strong upward pressure on selling prices. And so as a result, that's impacted affordability. And so, as households have looked to purchase a home, whether they're first-time buyers or moving up in the market, a lot of them have had to look further afield, broaden the scope of their search from a geographic perspective to find the type of home that meets their needs. And our members have been able to help with that. But that expansion of the geography, that broadening scope out into the greater Golden Horseshoe, which was originally focused on the GTA, just speaks to the supply issue and the impact on pricing that we've seen over the last number of years. Now, just sort of thinking about market activity, where we've been over the last decade or so, and obviously what we've seen unfold over the last couple of months. I mean, last year we had over 120,000 residential transactions just in the Greater Toronto area reported, and that was a big new record. Obviously, that was on the back of a very strong recovery from the initial phase of the pandemic and ultra low borrowing costs. Obviously, we've seen that situation change since March. And I'll argue in a few slides, actually, it was even starting to change before we saw movement on the part of the Bank of Canada. But essentially now, through September, we're seeing annualized sales more in sort of the high 70,000 to 80,000 mark. And I'd argue that when we finish off the year, we're probably going to be seeing transactions in and around 75,000 plus or minus, a couple thousand transactions. And so obviously a big pullback from what we saw last year. Interest rates were playing a big role there, but overall affordability was playing a role, and we're starting to see the cracks in terms of affordability and the feed through into demand, even in the second half of last year, and it was only magnified as interest rates started to creep up. On the pricing perspective, we've seen strong year-over-year price growth really in the first half of 2022, but that started to ebb as we moved through the second half of this year, certainly through the summer months. We actually saw a small year-over-year decline in the average selling price for the month of September. We're still looking pretty good on our original forecast. We had come in at $1,225,000 when we released our forecast back in February, and we're still hovering in and around that 1.2 mark. And so, we might be a little bit off that, but from a percentage perspective, pretty close to what we had anticipated in terms of the impact of borrowing costs and the hit that was going to have on affordability, and thereby, the mitigating factor of lower prices to help offset that on the part of home buyers. And just to give you a sense too, just on a per capita basis, because there's one thing to talk about home sales just on their own, but it's a little bit abstract. So just to give you a sense as to where home sales have been relative to the per capita norm over the last number of years. And so, if you look at the initial recovery from COVID-19, obviously we'd seen a real dip in the early phases of COVID, but then we saw a stark sort of turnaround as we moved through the second half of 2020 and even more so through 2021. And so we were running well above per capita norms. And so just on that alone, we had anticipated a bit of a pullback in sales, just because, arguably a lot of households have sort of pulled forward their decision to buy because of lower borrowing costs in 2020 and 2021. And then obviously adding to that, the affordability hit. Now we're running well below that per capita norm, and will continue to do so as we move through the remainder of 2022. So just to give you a sense on sort of a monthly basis, what's happened with sales, and how sort of different periods of sort of policy have impacted transactions. And so if you look at where we were running, say in 2016 and the first part of 2017 prior to the Fair Housing Plan, and then later the OSFI stress test coming into place, we can easily see what the impact was, at least psychologically, in the marketplace in terms of sales back in 2017. A pretty steep drop off, and then obviously following that, the impact of OSFI as well. And that gave us a bit of an understanding of where the market would go as we started to see the impact of higher borrowing costs. It was essentially the OSFI 2 percentage point stress test. That was basically an interest rate hike, because whereas before the stress test you're basically qualifying at your contract rate, afterwards you're having to now qualify at 2 percentage points or even more above your negotiated rate. So that did have an impact on the market, and so it helped us give us sort of a modern or up-to-date idea of sort of the impact of higher borrowing costs or changes to lending policy. COVID-19, big drop off that was relatively short, and then you saw that bounce back, and we were really running at those levels through the first half of 2021. But it's interesting because if you look, higher rates came into place in March of this year. Yet we'd actually seen seasonally adjusted sales on a monthly basis trending lower since the late spring of 2021. And I'd argue that, in fact, we are starting to see that affordability crunch hit some households midway through last year. It wasn't easy to eke out of the statistics just because, we were running at record or near record levels throughout the year. So, and certainly market conditions were very tight. And so, it was harder to discern versus, what we saw, from March onwards this year. But you're already starting to see that affordability hamper the marketplace this time last year. And so just sort of pointing out that the downward trend actually started in the spring of 2021. And part of that had to do with the fact that we were actually seeing borrowing costs, at least on the fixed rate side, in anticipation of Bank of Canada moves in 2022. We were already starting to see bond yields and then contract rates start to trend upwards as we move through the fall and winter of 2021 and into 2022. So obviously we're seeing double-digit price growth last year, and that was hampering affordability. And we're actually starting to see, medium-term fixed-rate borrowing costs edge upwards as well. And I think that had a lot to do with, the downward trend in sales even starting last spring and summer. And so then if you look at the average closing price and how that's adjusted, we didn't see much movement in terms of the closing price until we moved into the spring of this year. And it makes a lot of sense as we started to see real aggressive moves on the part of the Bank of Canada, and that feeding through into both fixed rate and variable rate mortgages. There had to be some sort of mitigation there to improve affordability, and that mitigation, simply put, came on the back of home prices. And so, with a little bit more balance in the marketplace and buyers benefiting from more negotiating power, we started to see the average selling price trend lower on a month-over-month basis. Now, I'd argue as we move through the remainder of 2022, you're going to see, a bit of a flatlining in terms of price. In fact, we've already seen it over the last 3 months or so, just sort of hovering below $1.1 million. And so, not as much of a downward trend as we saw earlier this year. And just to give you a sense of how that looks in terms of monthly payments, in February 2021, you're looking at an average monthly payment with 20% down on the average price home, about $3,100. In June of this year, we're looking at about $5,200, just because of the mitigating impact of lower home prices. And we did see a bit of a flatlining in contract rates as well. We're anticipating a bit of a pullback in that number, but still well above where we were this time last year. So it really gives you a sense, looking at this chart, how affordability has been impacted both by rising prices in 2021, by double digits, and then obviously by the steep uptick in borrowing costs this year. And so just sort of thinking about longer term though, because interest rate hikes and interest rate tightening cycles tend to have a shorter term impact on the market, and then households adapt. If you look back at previous tightening cycles, it takes 18 months to 2 years for those cycles to have their full effect on housing demand and for people to come to terms with that. But longer term, the demand for housing, and this is both for ownership and rental housing, is going to remain very, very strong. And this sort of speaks to the need of keeping our eye on the supply file over the medium to long term. And especially when you think about the GTA and even broader Greater Golden Horseshoe, our population doesn't grow in the region but for immigration. There's been stories this week about outflows out of the GTA and even out of the province of Ontario to other parts of Canada. And that's often been the case if you look back over time. But that's always been way more than offset by immigration into Canada. We're the single greatest beneficiary of immigration. And that's been a real factor on the housing market, because when we survey existing homeowners and then ask, well, were you born somewhere else and then you moved to Canada? Those people who moved from other parts of the world and purchase a home, their propensity to purchase a home is higher than people who are born here. And on top of that, they tend to spend more on average. And so that's been a real factor driving demand for ownership housing over the last number of years, and will continue to do so as we're seeing, record to near record levels of immigration into Ontario right now. And again, a lot of that is focused on the Greater Toronto area. And so, thinking about the other factors, so obviously we're seeing strong population growth, and we'll continue to see that. And on top of that, we're seeing very tight labor market conditions over the last number of months. And so we're attracting people from all around the world to take advantage of opportunities that exist. And a lot of these opportunities in the GTA and DGH are average to above average earning type of jobs, type of employment. And as those sectors of the economy that over the long term have driven demand for housing. And so the real issue then longer term is going to be lack of inventory, because as we start to see people come off the sidelines, perhaps not this year, but as we move through 2023, all measures are suggesting that they're going to be up against still a very, very low inventory of homes for sale. And so one of the things we made a point of highlighting in yesterday's release with September numbers is the fact that new listings in September were at a 20-year low. Right, and that's highlighted here in orange. You got to go back 2 decades to see lower new listings than we saw. And all the while, don't forget, the housing stock and the population has been growing in the Greater Toronto area. So on a per capita basis, that scenario is even worse. If you look at active listings, which is just standing inventory, a snapshot of standing inventory at the end of each month, we saw a bit of a spike upwards as demand dropped off. So we weren't absorbing as much in terms of listings during the initial phases of rate tightening. We've actually started to see active listings turn in the other direction. And so again, up from where we were this time last year, but still very low from an historic perspective. And that's why we're still seeing months of inventory. We're seeing lower than 3 months worth of inventory in the marketplace, even with the stark change in housing market conditions over the last few months. And so we're sort of thinking forward then, what do we expect to see? Well, number one, it's not surprising that we're seeing new listings down this year compared to last. When we polled at the end of last year, we actually saw listing intentions dropping off relative to 2020 and even previously in 2019. And so there's a lot of people out there in the marketplace, and I know other speakers today are going to talk about this, that would like to list their home for sale if they felt that there was something that better met their needs in the marketplace, either in the resale or new. But in too many municipalities around Ontario, those opportunities just don't exist. And we've been talking a lot about, missing middle. We've been talking a lot about, transit area development and a broader breadth of housing or array of housing to meet needs. And that'll be extremely important moving forward, whether we're talking about understanding policy direction in the upcoming municipal elections. I know Minister Clark is coming on later, and we'll be speaking to, his government's housing plan, and certainly as that relates to the transportation infrastructure development that's been taking place over time as well. So, compared to 5 years ago and 10 years ago, the housing supply file is much more top of mind, but we can't let the short-term impact of demand mask the fact that we're still experiencing a huge constraint, both in terms of bringing resale listings online and bringing new homes to market and getting shovels in the ground. I'll just finish off with a couple slides on rental, because it's not just the ownership market that's been impacted. We're also seeing listings. If you're looking green on this chart, we're actually seeing condo apartment rental listings drop off pretty dramatically from where we were in 2021, and that's seen a drop off in transactions as well. It's not because the demand's not there; it's just that there's not as many units out there to meet rental demand, and so there's quite simply would-be renters, fewer of them have been able to get deals done just because the supply isn't there. And the end result is a new high in terms of average 1-bedroom, and I could say this as well, 2-bedroom condo rents as we move through the first half of 2022, surpassing the pre-COVID peak set back in 2019. So with that, I'll stop sharing and I'll turn it back to Todd. I'm not sure if there's any questions, or if I guess we do have some time for questions. So certainly happy to entertain them if they come through the chat, or if Todd, if you want to relay them.
Yep, thanks, Jason. We do have a couple of questions. So let me get started. One came in, it says that CMHC projections, which were published June 2022 on page 20, apparently, their latest report show that housing supply will keep up or surpass population growth over the next 5 years. So how do you reconcile that with the claim that there is a housing supply shortage?
Well, I mean, just when I look at the numbers that I was showing on the chart, I mean, new listings are at a 20-year low, and before we saw a bit of a dip in demand as a result of higher borrowing costs, we were measuring months of inventory, not in terms of months anymore, but in terms of weeks or even days in some neighborhoods. And I'll tell you, when you start to drill down into some neighborhoods within the GTA, you are starting to see, again, sort of inventory levels in that sort of, weeks category, and you have started to see a bit of tightening up. And so my concern is that, when you're looking at current market conditions and certainly a marked pullback in demand, it's easy to say, well, look at like market conditions have balanced out. We're seeing actually a downward trend in pricing and price growth, so everything's going to be okay. But the minute even say half of those people come off the sidelines and are up against sort of the supply level that we're at right now in the resale market, you're going to see a massive tightening, and you're going to start to see that competition between buyers come back, and that's going to exert upward pressure on pricing. The other thing, and I know Ted's coming on later, I guess after me, and he can talk about CMHC's point of view in a little bit more detail. But the one cautionary note is that looking at supply in the aggregate oftentimes isn't perfect either. And one example of that is the condominium apartment market. So a lot of the new supply that's come online over the last decade in the GTA has been in the condominium apartment sector. But if you just say, look at, that's an ownership type, right? The condo tenure, the condo apartment type, that's focused on ownership, and that's how it's classified by CMHC. But in reality, a lot of those units are actually find their way into the rental market, thousands each year. And CMHC publishes that in a separate report, their rental market report, where they look at the secondary market. And so if you net out, those condominium apartments that on net get added to rental, then that's supply that's not directly pointed at the ownership market anymore. So it's important to look at those types of nuances. Number two, we've heard a lot about the missing middle. And so just the fact that we're bringing on, say, a lot of condos and to a lesser extent, say, single detached homes. What we haven't brought on a lot of is those types of homes that bridge the gap between condominium apartments and traditional single family homes. And so we don't have that continuum that allows people to easily move up and down through the market over time. And final note, Cancia did a study for TREB a few years ago, and they did a similar study for the city of Toronto even more recently, where they looked at the number of empty bedrooms in the GTA. So you have a lot of more aged households that are maybe living in a 3 or 4 bedroom house. They'd like to move into something smaller, but they want to stay in the neighborhood they're in or something similar, and they just can't find the type of housing that's going to meet that need. So they choose not to sell. Right, they don't list that home for sale, and so that's been a constraint on supply as well. We'd see a lot more movement up and down the housing continuum if we had a greater diversity of home types. So again, it's not just looking at housing supply in the aggregate, total completions or total starts or total new home sales, but it's also the mix and where those units end up upon completion. Are they actually being used by end users, or are they finding their way into the rental market?
Thanks, Jason. A few more questions have come in. One of them is TREB expecting there to be a large number of people who will be forced out of their homes when their mortgage rates increase if they bought at the height of the real estate market, like, for example, this past summer?
Yeah, I mean, I think if you look at past housing market cycles where we've seen higher borrowing costs or other shocks to the system like job losses and what have you, that has resulted in softer market conditions for sure. But if you look at defaults, even during recessionary periods in Canada, certainly drilling down to Ontario, they've remained, remarkably low. And that's, in comparison to other jurisdictions like south of the border and parts of Western Europe as well. And I think it speaks to the fact, number one, the average Canadian household isn't given enough credit in terms of managing their household balance sheet. And number two, Canadians in general are loath to default on their mortgage versus other obligations.
Another question was, could the recent dips in inventory listings and buying intention be a reflection of lower demand following the pent-up demand of buying intention that you mentioned for 2021?
I think certainly there's something to that point. I think number two, number one, if you don't feel that you're going to get the price you want for your home, perhaps you don't list it. But number two, if you look at all the other drivers that support housing demand over time, there really hasn't been a lot of change. That's not to say it couldn't change moving forward as we move into 2023. Obviously, talk of recession is much stronger now than it was even a few months ago. But right now, the great majority of people who want to work are working. In the GTA specifically, and even broader Greater Golden Horseshoe, a lot of the job opportunities that exist and where market conditions are the tightest is in those sectors of the economy that support, average to above average earnings. And so, if you don't have, a lot of people just don't need to list their home today, and if they don't feel that they're going to get the price they want to allow whatever movement they wanted to make in the marketplace, they simply won't. And so that's a factor on top of the other issues that have impacted housing supply over the last number of years. It's been the vicious circle where we just don't have the type of supply that people want to move into, so they stay put. On top of that, you have upfront costs like multiple land transfer taxes that also cause people to say, look, I don't want to sort of throw that money into the wind. I'm going to choose to renovate my home instead. And renovation activity throughout the pandemic and before was extremely strong. And so that's the other point. We've seen a lot of people that were would-be listers. They wanted to list their home, say to move into something different, but they weren't confident they're going to be able to do so. And so instead, they renovated their home. And so now, they almost have a new home that they're buying into for at least a decade, let's say. And so, number one, they're not planning on moving. And number two, it's also changed the stock forever. So think about that. If you had purchased, say, an entry level, semi-detached or detached home, and then you said, look, I'd like to move into something bigger. There's nothing really out there, so I'm going to renovate instead. And you add 50% more floor space. So now you've changed the stock forever too. And so that housing continuum where people can move from, say, a townhouse or a semi into a smaller detached home, well, there's less and less of that stock now because it's been changed because people felt they had to renovate rather than move for multiple factors.
Okay, I'm going to try to sneak in one more before we end the session. And I think this was a question while you were delivering your remarks, was something to the effect of, if you're saying that physical supply is there, is it being purchased by investors to use as rental properties? Is that why it's not in the market?
Well, look at rental supply in the GTA over the last decade hasn't grown but for investors, right? We haven't seen very much in the way of purpose-built rental activity. And certainly it's paled in comparison to the number of units that have been brought online by investors over the last decade. And so I always caution, like I understand there's concern about investment. I understand there's concern about speculation in the marketplace and what have you, and the impact that could have. We've talked a lot about foreign buying activity over the last number of years also. But if you didn't have over the last decade to decade and a half, investors purchasing units at the pre-construction stage of development, holding on to those units, so essentially bearing that risk during the construction period, and then many of them choosing to rent them out upon completion, the rental market would be even tighter than it is today. And I'm not sure, but maybe Ted will be speaking about vacancies historically in the condo market, but it's always been quite low. And certainly, when you're looking at the rental growth and average rents right now, you're talking about double digits on a year-over-year basis. Imagine what the scenario would be, if we hadn't seen the supply come online on the back of investors over the last number of years. So, I understand the concern around investment, speculation, what have you, but I always caution, be careful what you wish for, because if we preclude investment, especially in that condo space, a lot of those investors, they're the reason why we've seen on net addition to the rental supply, albeit still quite low from a population growth perspective over the last decade or so.
Well, thank you, Jason. I guess that's a good segue into, we'll hear more about all this from Ted. So our next session is CMHC Supply Gaps Report with Ted Stakopoulos. And he's going to highlight the coordination between transit and land use policies that can help fill supply gaps identified in their recently released report. So to access the session, go over to the agenda tab on your app and open that session. We'll see you there. It starts at 1:50. Thanks. Thanks again, Jason.
Thanks very much. Have a good day, everyone.